Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jay Darren Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today, my guest is Jim Oliver. Jim is the world's foremost authority on the infinite banking concept and has dedicated his career to breaking the financial shackles that bind people and businesses to unnecessary taxes and interest expenses. And in just a minute, we're going to speak with Jim about infinite banking. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you'd like to see how handsome our guests are, be sure to check out our YouTube channel. And you can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Jim. Welcome to CRE PN Radio.
Thanks for having me, Darren. I'm excited to be here and share with your audience today.
Well, I'm looking forward to our conversation. Before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, absolutely. So I grew up in Los Angeles, went to school in the Midwest. It was a big change. And I decided, because I grew up very poor, stood in line for government cheese and lived in Inglewood, California. I decided that I was going to study money. So I went to school, became a financial planner, and set up shop in Denver, Colorado, and thought, okay, this is great. And I studied everything I could find on money and Wall Street and everything that I could find, like how to get rich in Wall Street. And after 15 years of doing that, I didn't say I was a quick learner, Darren, but I looked at our portfolio and I had about $700 million under management. So we were doing pretty well, but I looked at what our actual rate of return was versus what our platforms were telling our customers their rate of return was. And now you would think those two things would be the same, but they weren't. The platforms were telling my customers and me that they were getting 9.38% over the last 10 years. They were actually, their CAGR, compound annual growth rate, was a little over 4 after fees, taxes, expenses, etc. It was then that I started to look at all of my clients and how much money, or how they made their money, excuse me. And I found that there were two ways: real estate and businesses. Now, at the time, I didn't realize, real estate is a business, right? So it's real estate and businesses. And I started to study real estate and business ownership. And I shifted all of my focus to that and how I was going to help my customers build wealth in real estate and businesses rather than in the stock market. I've been doing that 18 years.
No, I'm interested in hearing more. Full disclosure here, I'm a son of a banker myself, and I've learned a few things that just putting your money in the bank, as I was told as a kid, is not exactly the most prosperous way to take care of your money. But so you were a broker then? Is that basically, or a certified financial planner, or what?
Yeah, I was a fee-based financial planner, full service. Okay. Sit down, you guess a little bit. I ask you questions and you guess, and then I guess, and then we hope together that you're going to build your wealth over a 20, 30, 40-year period. And yeah, had all of the terms down. We had, how much you needed to invest, how much time, inflation, everything else. And look at this, in 40 years, you can, quote, retire, which means to be taken out of service. And you shouldn't run out of money based on the Monte Carlo method. I did that for 15 years. That's all everybody was telling me that's how people make money.
Yeah. No, it's interesting. I'm kind of curious. What was the light bulb moment for you that caused you to shift gears and quit that?
Yeah, all of my clients that really, that didn't get lucky, right? They didn't work at the right company at the right time or something like that. All of my clients that didn't get lucky, they built their wealth with real estate and business ownership. So why would we try to build somebody else's wealth outside of that? And I really couldn't find any good examples of somebody middle income, upper middle income, et cetera, that had built some great fortune in Wall Street. And it was a mentality of scarcity. And I like to think that I don't live in that scarcity mindset. And I think that I realized that the noise out there, that it's designed to keep us in that scarcity mindset. So that was kind of a light bulb moment.
Got it. So when you realize this is that real estate and business ownership were kind of the paths to actually creating wealth, what did you where'd you go? What'd you do?
Yeah, I mean, that's a great question. What I did is I started reading everything that I could get my hands on. Going again, I was in Denver at the time, going to any real estate seminar, course, anything that I could sign up for and that I could attend. I started talking to my clients that built big real estate portfolios or big businesses. I remember a guy that started a plastics business, was a big influence on my next steps. And so I just started interviewing clients and interviewing people that had done it. And I just found, a treasure of information. And it came down to, it looks simple, might be simple, but simplicity is elusive. It's not, it's some of these techniques and some of these systems are tried and true, but they take, they take work, they take education. So took off
Got
from
it.
there.
So what are some of the techniques? And I assume that's how we get to the infinite banking. Is that one of the concepts or the technique that people were using?
Yeah, I mean, I always ask people is, Darren, if I would loan you $100 million today, and your only obligation was to pay me $5 million of interest 1 year from today. So I'm going to give you 100 million today, and 1 year from today, you got to pay me $5 million of interest.
Sign me up.
Are you going to take the loan?
Yeah.
Absolutely, right? Because you know what to do with the money. So let's reverse that for a second. What if you made me the same offer, and Darren, if you are making that offer, I'm open to talking after the show. You loan me 100 million bucks. I'm going to go to the bank or the seller, and I'm going to get 80% loan to value. So I'm going to get another $400 million. I'm going to buy $500 million of real estate. My standard, and we're getting slightly better than this, but is 25% cash on cash. So I'm going to make 25 million because I got your 100 million in it, right? And I'm going to call you at the end of the year, and I'm going to say, hey, Darren, I'd like to fly out to Portland and buy you lunch and give you your check. And we get together, and you say, Jim, hey, do you want to pay any principal? And I say, nope, see you next year, right? That's kind of how infinite banking works. And that's what I discovered is people can find deals. I'm not saying it's easy, but we can find deals. It's putting the financing together and it's managing the debt. So how do we do that? Well, if we can control the banking function, which is what infinite banking concept does, then we're way ahead of the game. And what we do is we get a loan, kind of like I just said. We use a very specifically designed insurance contract that's designed for cash value. It's guaranteed. You have the right to borrow up to 100% of the cash value, right? With an interest-only loan. And your money never leaves your account in this tax-favored account. And the insurance company has to give you their money, kind of like I just said. Now it's interest only. Now I can take that money, the insurance company's money, while my money's in there growing tax-free, and I can go and I can leverage that with the seller, is what I would prefer, or a bank that wants to play with me, and I have control over that more so than if I'm putting my money in, right? And so then as that property starts to cash flow, I'm going to flow that money back to my insurance contract until my next deal. And then all of a sudden, I have multiple deals that are appreciating in value, cash flowing. I have money in my insurance contract that's growing tax-free. I have a loan against that, right? And when I have windfalls, if I sell a property or whatever, I can put that money back in that insurance contract. But all of my cash flows back in there, which reduces my interest expense. And I just do it over and over and over and over again until the policy won't hold the cash flow.
Okay. So, and you mentioned you were kind of slow learner. I'm going to challenge you on that because sometimes I know I'm a slow ski here, but the basic concepts, if I understand right, the insurance contract is kind of the vehicle that provides the in and out. If I have and I'm assuming these are life insurance policies. Is that?
Yep. They're especially like they're a combination of a paid up additions rider, which is like a one pay insurance policy,
Okay.
and a standard whole life policy. And the reason we use that is because there's guaranteed growth in the whole life policy. In the universal life, there's not guaranteed growth. So it has to be a very specially designed contract. We write it right up to the MEC line, which is the definition of life insurance. Over the MEC line being too efficient means it doesn't get all the tax benefits. So yeah, it's a life insurance contract, but it's designed like a bank or corporation would design an insurance contract with BOLI, bank-owned life insurance, or COLI, corporate-owned life insurance. It's designed that way, not kind of how normally consumers buy life insurance.
Got it. So the policy is still underwriting your life, presuming
Yeah.
you're healthy and the premium amounts track all that. I'm assuming. I mean, although it's a paid up policy, can you explain a little bit of that? I mean, so if I had, I guess, what's a minimum amount that people usually start with to make this a viable option?
You know, it's funny because when we think of buying insurance, we say, okay, we want a certain amount of death benefit. What's the minimum amount that we could pay for that death benefit, right? But because of what we're doing, Darren, people think differently on the funding level. So they don't really think of it in minimums. They think of it in what cash flow do I have right now, either from my W-2 job, my properties, or something else, that I'll flow that money through the insurance contract first. Instead of holding it in the commercial bank, I'll hold it there until I need it for escrow, for whatever it is, right? And so people start from $10,000, $20,000 a year to millions of dollars a year. In fact, let me give you an example, and then I'll go back. There was another part of your question. I'll remember it here in a second. But we have a real estate investor in the Midwest that has about $120 million of real estate. Now, by the way, they've done that in the last 7 years. Which is pretty amazing, right? And their escrow is about $175,000 a month at the time, right? So what they came back and they said, can I run that 175 per month through the insurance contract? Then when I need money out for escrow, I'll pull it out, and every month I just keep putting it back in. I said, absolutely. So the difference for them is there's a point around the 5th year, maybe a little bit sooner. It just depends on your age and underwriting. but where every dollar you put in there, Darren, you have more than a dollar to use, right? So like in year 10, if I put 40 grand in, I might have 60,000 to use. Now, if I'm running that, if that's my escrow money, I just got a big discount, right? Because I got more money to use than I put in there. And so normally people buy life insurance where they're letting it sit there, it's accumulating. And again, over 20, 30 years or whatever, they say, this is how much money I'm going to have. And then they say, is that a good rate of return? Is that not a good rate of return? Whatever it is. We're using the money. You're exactly right. This is just the place we park the money. It's the money pool. It's not infinite banking. That's a process, not a product. Okay. So the insurance contract it's kind of like cogeneration to think about, like up in your neck of the woods. You might have a lumber yard next to a paper mill, or something like that, where you have wood and then you have paper, and they work together. And so the insurance contract and then your behavior and the cash flowing assets, they all work together in concert. But now I remember the other question is, you can buy, here's the cool thing. Okay. So I'm 56. I have some business partners that are all the way down to 24. That's my youngest business partner. I can buy insurance on them because I have insurable interest. I'm the owner and I'm the beneficiary. They're just the insureds. They have no control over the policy. But I can fund buy sells. I can make my business and my partners more secure and myself more secure, all while I'm becoming my own banker and controlling the banking function in my life.
So the vehicle is basically, it's just a vessel, quick in and out. I mean, you have maximum flexibility. You can put the money in, you can take the money out up to 100%. Is that?
Yep. Yeah. And here's another thing, because when we think of loans, we think of approval processes or applications or anything. There's none of that. They have to. It's a contractual right that you have to take that loan. You literally sign a form and we scan it to them, and we literally can have your money. I mean, I've done it in the same day, but let's just say by tomorrow.
So okay, so I get basically the initial concept is the individual you created in some sort of like a corporate structure, as opposed to just a straight pay down or like a life insurance policy. I mean, it's more like this vessel that has a maximum flexibility. So if I have income of 10 and I keep putting that in there, eventually that the availability can grow beyond the 10 per month, to where I can borrow more. Is that, am I tracking?
Yeah, absolutely. Because of and it's each year as you're putting money in, like, so let's just say, to make the math easy and I can think of the percentages in my head. If you put 100 grand in by like the third per year. Okay. So like by the third year, you put 300 grand in, you're going to have a total cash value. But the way that we look at it, because it's not sitting there, most of that money's probably borrowed out, is you put in 100 grand, maybe you have 107,000 to use in the third year, right? It gets better every year. So we use it as a cash flow system, not an investment where we're letting the money sit there. So, this reminds me, Darren, that it's a mind shift. I mean, it's changing our thinking. It's a different paradigm, but it takes a little bit of time for people to change that paradigm, because everybody thinks of life insurance like other investments or savings vehicles, where you put money in there and let it sit, and then, okay, what's my rate of return? It's not that. It's really compared to like your checking account, because you're going to flow money in, you're going to flow it out, and basically you're like collateralizing your checking account. But your checking account in this example is in a tax favored vehicle. So there's literally, as long as you don't let the policy lapse, you can never pay tax on it again, on the growth or the access to it. There's no tax on the death benefit to the next generation. So there's legacy planning, and it leverages. There's a point in just a few years where you put in $1 and you have more than $1 to use.
Gotcha. So the leverage is not an instant option. How long does it have to season before you can leverage that?
So like, I'll give you an example. If you were a woman under 50, it leverages in the second year. I mean, it's just crazy because women live longer than men, right? If you're male and you're under, probably 46, 47, it's going to be right at 100%, maybe 99, percent. Right at 100 in the second year, and then the third and fourth year it'll start to leverage. If you're in your 60s, and I think we had a client that was 85 that started this when they were 78 or 80. They unfortunately passed away, but if you were in your 60s, it might be the fourth or fifth year, maybe the sixth year before it starts to leverage. But again, if I'm in my 60s, and let's say that I'm in poor health, but I have a business partner who's in their 20s, 30s, or 40s, I can insure them, or their spouse. I can insure my spouse if they're healthier or younger, or any of those things.
Got it. And I guess at the end, if the policy gets called because there's a death, then I'm assuming the benefits are less whatever is outstanding as far as the loan goes.
Absolutely. That's what's really cool, is if you wanted to turn this into an income stream, you could, and you could take out all of the cash value over your lifetime, and then your heirs get what the policy minus, they get the death benefit minus the loan balance. But think about this for a second. If you were going to, say, write insurance on a business partner, and the business partner dies, you get a tax-free death benefit. So, there's a lot of things, a lot of different planning things for everybody's specific situation. But, I've used it in so many different ways and so many different businesses, and it works with every business. It's just, how does it fit for each business?
Got it. So, okay. So I understand the basic concepts of the who, the vehicle, and the opportunity to leverage, after it's seasoned, and you've got, quote, more than the cash value that you've put into the account available to you. So the in and out thing, if we could go over that one more time. So if I'm just, again, round numbers, easy numbers, if I'm putting 100,000 a month in, and let's just say it's 100,000 a year, so 10,000 in, 100,000, you get to the magical point of, say, 3 years, so you've got 300,000 in. At that point, presumably it's worth, but 400,000. Is that too much, or is that?
That's probably a little bit high because we're in a low dividend, because we're in such a low interest rate environment. But
okay, but the use of the cash, I guess, what I was trying to figure out. So,
yeah.
So if let's just say it's worth 300, because I've put 300 in, it's 300.
Yeah.
So, but now I can leverage that 300 up to what, 400 or?
Yeah, well, there's two different leverages. Like I could take that 300 and then I could go use that as 20% down payment, go buy some real estate, have that real estate. So, because remember, we're talking about just the way we design the insurance contract,
right.
And that's just the money pool. But where the real magic happens is taking that money. And even if I was going to, I'm going to go to somebody who syndicates real estate, because I want to do it passively. I don't know anything about it. Let's say whatever it is. It would work slower, but the way that I would do it, the way that you would do it, Darren, is that you would take that 300 grand and then you would use that as a 20% down payment. And you would go out and buy, you'd go out and buy, what am I trying to say? If that was 20, what's 20%, 80%? You'd go out and buy,
1.5
2 million,
Or,
Yeah, $5 million worth of real estate, let's just say, right?
okay.
Okay. And so then on that real estate, then I would expect to get 25% cash on cash. So I'd get $75,000 and that would flow back into my system. So let's say the next year I put in 100 grand, but I got the 75 to use again, right? And then I'm going to take that 175. I'm going to go buy $2 million worth of real estate or whatever it is. And then I'm just going to keep on doing that over and over and over again. And pretty soon the cash flow won't fit in the policy. And I have to have more policies. That's why it's important to have the know. I mean, like there's only so much they'll write on one person, right? And so then, that's where we expand out to partners and everything else, even people running your property management because you have insurable interest on them. So that's how I would leverage it. Now, some people do take that money and they say, okay, I'm going to take that 300 grand and I'm going to give it to somebody syndicating real estate and they're buying assisted living facilities and they're going to pay me 20%, over per year over 3 years, but nothing the first, whatever the deal is, right? Then I can still draw that out with the cash flow. It just takes a little bit longer because there's no seller or bank financed leverage.
Gotcha. And so as long as you circulate money through this thing, you keep the policy paid up, the cash is available, or at least a large percentage of it is, and allows you to continue to go out and leverage and create more. Is that kind of the?
Yeah. So what we're kind of trying to do, this is maybe an example that'll help, is if you think about a mortgage, just your average everyday American who has a mortgage on their house, right? Let's say they're going to buy a $300,000 house. It's 5%, 30-year mortgage, and the payment's $1,600 a month, right? I'm just making these numbers up. So when you pay that bank that $1,600, what does the bank do with that money?
Well, they take most of it for interest and you put a little against the principal.
Yeah, but what they do really is they just take that money and loan it right back out, right?
Right.
And so they'll take your payment, my payment, the audience's payments, and they'll pull them all together and loan it out to somebody else. Now, again, we can't do fractional reserve lending, but so sometimes people jump to that. I'm not saying that, but what the bank does is they loan that money out every time you make a payment over and over and over and over again, because the asset is the loan, right? For the bank, and you mentioned your dad was in banking. The asset is the loan. Everybody that works at the bank, they're trying to get deposits in so then they can loan those deposits out, right? And that's I own part of a bank in South Dakota. And if we were in a board meeting, we're not talking about, we're only talking about one thing. Not really. We're a lot of things, but the one focus is, how is our loan portfolio doing? How are our assets doing? Right. And, then it's who's late, who's, whatever it is. But when what we're doing is we're turning that liability, which most people think that when you deposit money at the bank, that it's a asset, but it's actually a liability for the bank. They make it an asset by loaning it out. The loan is the asset. Excuse me, sorry.
No, it is a flip the script kind of a thing when you realize the value of it is an asset by lending it out, as opposed to the liability of having it on your books there. So let me ask you this. So I get the basic concept, and this is as opposed to not having a life insurance policy and just having a mortgage, or being limited to to your own, I guess, capital, the ability to go out and raise capital or invest. If you were to put the same amount of money into a savings account and wait until you had or enough on hand to go buy another property, essentially a similar scenario. The difference is you wouldn't have the protection of life insurance or the tax vehicle of a life insurance policy. Is that, am I tracking as far as a comparison?
And remember, at some point in time, every dollar you put in, you have more than a dollar that you can go borrow because the policy leverages. The reason it leverages is because it never leaves that account and it's accumulating, right?
Right.
But, and that's the way people think of life insurance. My cash value is going up every year, just a little bit, boom, 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 boom. But we're using that insurance company's money while our money's sitting in there and growing. So it literally gets to where I put that 100 grand in, and let's say at year 10, I can take and go invest 150 grand because my policy's growing by that deposit, and I'm taking, and I have all the money borrowed out using it for real estate. This part of it, Darren, is a little bit easier to see. It's more visual, seeing the tracking than it is verbal. I'd be happy to give you some links to videos that we've done that literally draw this out, so you can see kind of how it all works together. And we do have real estate examples in there that again are drawn out. You can see the math, and we have people that I use 25% cash on cash. I have sometimes people say to me, they're at 27 or 28, or they're 23 or 20. It doesn't really matter. It still works. It's, again, I'm just, for an example, I'm just trying to use, it's just for illustrative purposes.
Gotcha. So let me ask you this. So the good news, if I'm hearing all of this, is basically that you have the benefit of a life insurance policy. You have the ability to leverage the cash value in the policy to where you can go out and create more investments, more equity, more cash flow. So what are the risks of this? What's the potential downside or something like this?
The downside really is kind of the same as like at a bank. If they have because of the deposits, if they're just sitting there and they don't use them, then the bank's in trouble. Right now, it's not that harsh here because it would just gain, just would earn dividends and just kind of chug along like a normal life insurance contract that somebody might buy. But it's not going to give you all of the things that we're looking at. It's not going to give you all of the freedoms to take over the banking function. So sometimes people, just like anything else, they start it and then they don't take their first loan. They don't go buy their first property. They don't go, and the only risk there is now you have to fund insurance, and you're not letting, and you're using your income to fund the insurance instead of using your assets to fund the insurance. And that's not really the system. So that's a danger. It's something that I would say that wouldn't be as desirable. I mean, it's not like it's going to hurt you, but then you got all this money in the insurance contract that you're not using. But that's kind of rare. What we try to do is when somebody starts, we send them videos, we send them articles, and they figure out with their imagination where their niche is, right? So if you and I, if you were coaching somebody on how to get into real estate, and let's say commercial real estate, right? And I mean, you would say, okay, here's what you need to start to read. Here's what you need to listen to. I'm going to coach you. I'm going to do this. And okay, now I want you to go evaluate 10 deals or whatever it is, right? I mean, you have a system. And so if that person at some point in time, 90 days in, says, yeah, I'm not going to evaluate any deals, well, then they're not going to get the benefits that you're trying to show them of buying commercial real estate, right?
Right. No, that makes sense. So the downside is basically for if you don't take advantage of it. That's
right.
Basically what I'm hearing say. So let me ask you this question, because I think that what we've certainly learned here in last couple of years and the potential going forward. Nobody knows exactly what's going to happen. But there's always a potential for like a change in a law or something. Are there any unique laws that this life insurance takes advantage of that potentially could, uh, change and this the ability to use this policy this way change?
Yeah, that's a great question, Darren. And the life insurance, whole life insurance has been around since the 1650s in England, been over 250, around over 250, almost 300 years in the United States. It precludes or pre-existed federal income tax, right? So that's one thing. The last time that they changed the law was in 1988 during DEFRA. I don't know if you remember those tax changes, but it limited how much money you could put inside the insurance contract for a given death benefit, and that was the Internal Revenue Code 7702's definition of life insurance. Everybody that bought an insurance contract before 1988, they were grandfathered. So if they changed the law again, because I don't know, they would really have no way of undoing all of this, right? Then you would be grandfathered. The other thing that protects us, in my opinion, is that there are so many people that are elected officials that do this. It's kind of like the real estate laws. It's very interesting how somebody can spend their whole life in public service and become a billionaire. But
Right.
if you look at their portfolio, they invested in this real estate, this property, whatever it is, right? So in my opinion, they're not going to go and change these laws and hurt themselves. And then you have the insurance lobby, which is very strong. Can you imagine if they took away the tax deferred growth and the tax free death benefit inside of an insurance contract? Well, then most people would not put money inside of an insurance contract. So if they didn't do that, then there wouldn't be any private protection, which means the government would have to protect everybody. Again, a negative. And if you go back to before 1974, when the IRA was invented or was introduced, people would put up the 50% of their savings in life insurance contracts and just let it accumulate, because they could turn those life insurance contracts into a type of pension at retirement. The IRA really took all that money away from the insurance industry, and so if they did that and people didn't have private life insurance, it's going to get a lot more expensive for the rest of us.
It's interesting, just that history. I forgot about the life insurance being kind of the vehicle pre-IRA. So definitely things can change, but like you said, the fact that the policymakers are the ones that are typically taking advantage of these things, I think that's some insulation from change that would make it punitive to do so. So that's good. So in summary, is there a person you think this works best for?
I think it works for everyone. I really like, probably I see people get really excited about it that are real estate investors, business owners, entrepreneurs. I'm not saying that somebody working a W-2 job doesn't get it. They do. Okay. And we have lots of clients that are working W-2 jobs. We have a lot of doctors, attorneys, things like that, CPAs. But it is a paradigm shift for them. Kind of like if you were looking to get into commercial real estate, it's a paradigm shift for that W-2 employee. Now, sometimes the most exciting people to work with are those W-2 employees that haven't broken out of the rat race yet. And because they see this as a vehicle that can accelerate that for them breaking away.
Gotcha. Hey, Jim, if we could, I'd like to shift gears here for a second.
Absolutely.
By day, I'm an insurance broker, and I try and work with my clients to assess risk and determine what to do with the risk. And there are three strategies that we typically look at. We first look to see if we can avoid the risk. And if we can't avoid it, then we look to see if there's a way to minimize the risk. And when neither avoid nor minimize the risk are options, then we look to see if we can transfer the risk. And that's what an insurance policy is. And I like to ask my guest if they can take a look at their own situation. Could be their clients, investors, tenants, the market, however you would like to identify the risk and consider what is the biggest risk. And for clarification, like I said, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer. But if you're willing, I'd like to ask you, Jim Oliver, what is the biggest risk?
I think the biggest risk is inflation. And I think that because the dollars in our pocket are going down in value so fast, that if we have a bunch of dollars sitting around, fiat dollars, then we're in trouble. I mean, if you gave your kid $20 to put in a savings account today, you'd be doing them a disservice, because that $20 isn't going to be worth very much as we go along. And my example of that is when I was a kid, we could buy about 5 candy bars for $1, right? Maybe a few more. And now you can't even buy one. So if the dollars in my pocket are going down in value, how do I combat that? So I could say taxes, but taxes are going to go up and down. And I believe taxes have to go up based on our debt, right? But inflation is really a stealth tax, because the dollars are going down in value, and every time the Federal Reserve prints money, then my value is going down. That's a threat to me. That's a risk to me. And the only way that I know of well, by the way, you could take all your money and put it in cryptocurrency and get out of the fiat system. Okay. And I'm not discouraging somebody to do that, and I'm not encouraging somebody to do that. Okay. But you can get out of the fiat system, which is one of the reasons that these cryptocurrencies, these digital currencies exist. Right. And then, but you can buy assets, because if I own assets that are appreciating in value, that I have tenants and customers that pay me to use my space, if it's real estate, or if it's a business, I can raise my prices. If it's real estate, I can raise my rent. I can keep up with inflation. So that's the biggest risk, and that's the answer in how to mitigate that risk.
No, that's a great answer. And I think in the years that I've been doing this, you're the first one that's actually said that. And it seems so obvious. So I appreciate you sharing that with us.
Absolutely.
Jim, where can the listeners go if they would like to learn more or connect with you?
So you can go to createtailwind.com. The reason it's Create Tailwind is most people are fighting a financial headwind. We show you how to create a tailwind, right? And push you faster in the airplane. So Create Tailwind, all one word, .com, or you can go to our YouTube channel, which is Create Tailwind. And we've got video resources on there. They're also on the website too. There's links to the videos, but those are the best ways to get a hold of us.
Got it. Well, Jim, I can't say thanks enough for taking the time to talk today. I've learned a lot, enjoyed it, and I look forward to doing it again soon.
Thank you, Darren. Thanks for having me. And I really enjoyed it too. Thanks for all the good work that you're doing out there.
All right. Thanks. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.